Welcome back to Investing Talk Podcast.
Today we're looking at NXXT.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
All right.
With NXXT, we're really navigating what I call a classic, a really high-stakes growth paradox.
Growth paradox, okay.
It's the story of a company where the top-line numbers, the revenue, is just absolutely explosive. It's creating a serious buzz.
Right.
But then you look underneath that incredible speed and you find these deep structural profitability concerns that you just have to look at. You can't ignore them.
And that speed, that velocity you mentioned, it's really stunning. Let's start with the bull case, because these numbers are almost hard to believe.
They really are.
Looking at the preliminary data for October 2025, revenue came in at, what, $7.39 million?
Exactly.
That is a staggering 196% increase compared to the same month last year.
196%. I mean, that's the kind of number you expect to see from a pre-IPO hyper-growth startup.
Right, not a public company in the energy sector.
It absolutely demands your attention.
And the trajectory here suggests it's not just a one-off spike either. When you put all the data together, year-to-date through October, their total revenue is already sitting around $65.8 million.
Wow.
And just think about that for a second. The company's full-year revenue for 2024 was only about $27 million.
So they've more than doubled their entire previous year in just 10 months.
In 10 months. And their September performance, that was even crazier. A 229% year-over-year surge.
And that kind of velocity is exactly why the stock is generating so much excitement. But this is the crucial moment where we have to pivot.
Okay.
Because that spectacular growth is, it's kind of masking some underlying financial distress. The company is still profoundly unprofitable.
Right.
And what's worrying is that the net losses are actually deepening every year. They're not shrinking.
When you say deepening, what's the context there? Is this just, a typical high R&D burn for a tech company, or is it something more structural?
It's getting to a critical point. Over the last 5 years, their cumulative losses are over $50 million.
$50 million.
Yeah. And look, in this sector, some burn is okay. It's expected. But here, the margin issue seems chronic. The operating losses have consistently outpaced those massive revenue increases.
So for every new dollar they bring in, they're still spending more than $1 to get it.
That's it, exactly. We just aren't seeing those economies of scale kicking in yet to even hint at profitability anytime soon.
So we have what I call a rocket ship of revenue, but it seems to be powered by a leaky bucket. If the losses are at $50 million, where's the money actually going right now?
Well, it's leaking into sustaining that really aggressive growth. It's going into R&D to keep their tech edge, incredibly aggressive sales and marketing to grab market share. And critically, the cost to integrate recent acquisitions, like Refuel Mobile, it puts them on this kind of fundraising treadmill. Management has to constantly be finding outside capital just to keep the expansion going.
And that brings us right to the balance sheet. I mean, if they're constantly burning cash, how stable are the company's foundations?
That's where you see the biggest warning signs. Their tangible book value is negative.
Can you break that down for us?
Sure. For listeners who might not know that term, it just means the company's liabilities are actually more than its tangible assets.
So their debts are worth more than their physical stuff.
Exactly. You are not buying property or equipment or traditional hard assets with this stock.
Yeah.
You are betting entirely on, IP, future contracts, and management's ability to execute. It makes the risk profile incredibly steep.
That really does raise the stakes. If the physical assets can't even cover the debt, what about their day-to-day cash, their liquidity?
Liquidity is a major ongoing risk. They have severe, persistent negative operating cash flow, and their negative free cash flow is sitting at minus 3.55%.
So what that really translates to is what?
It means external financing isn't just an option for them to grow in the future, it's essential for their survival right now. And given that balance sheet, any financing they get is going to be expensive.
And probably lead to more dilution for shareholders.
Most likely, yeah.
Okay, that paints a pretty grim picture on the financial side. So if the fundamentals are basically screaming solvency risk, you have to ask, why are investors still pouring money in?
Right.
The only answer has to be the technology. What's their differentiated edge that makes people willing to take on this kind of risk?
Precisely. Investors aren't buying today's $50 million loss. They're buying the story, the narrative of future energy domination.
Okay.
And NXXT is operating in three, hypercritical, fast-growing areas. AI-powered microgrids, mobile fueling, and these next-gen wireless EV charging platforms. The market is bullish because it's an integrated solution, not just a single product.
But let's get past the buzzwords. You mentioned things like the NXXT system and Rencast analytics. How does that tech actually translate into a 196% revenue spike? Are they selling software licenses?
It's a mix, but the really critical piece is that NextUS system. That's their proprietary software that manages all these distributed energy resources, microgrids, solar, batteries, in real time.
I see.
So the revenue comes from multi-year software contracts, plus all the services for installation and maintenance. The Ringcast Analytics lets their customers, utilities and big companies, forecast power demand and spot failures before they happen. It saves them a ton of money.
So the ROI for the customer is immediate.
It's immediate. And that growth rate suggests they're just rapidly signing up large enterprise customers to this platform.
So the investment thesis is basically this. They have a superior software platform, probably with recurring revenue, and they are buying market share as aggressively as possible right now and just ignoring the cost.
That is the essence of this high-risk bet. They're betting that the scale and the stickiness of the software will eventually, solve the profitability problem down the road.
But how do they stack up against the giants, the NextEras or Brookfield Renewables of the world? Do they really have a competitive moat here?
They're definitely early stage compared to those powerhouses. I mean, the big players have operating scale, they have the regulatory relationships, low-cost financing, all the things NextNRG desperately needs.
So what is their moat then?
Their moat is purely tied to platform innovation. They're nimble. They can tackle these infrastructure modernization problems that the giants haven't really solved yet. So they're niche innovators, but they just lack the stability of the big guys.
That makes a lot of sense. The innovation gets them the attention, even if the balance sheet is frankly terrifying. So let's pivot from the fundamentals. Does the market actually agree with this growth story? What are the charts telling us?
The technical setup confirms the market is, for now, buying the story, not the balance sheet. The stock is trading confidently above both its 50-day and 200-day moving averages.
Which is a strong bullish signal.
It is. It confirms a strong short-term bullish trend that's really been in place since early in the third quarter of 2025.
And where's the stock priced right now? What are the key levels people should be watching?
It's trading around $2.03 right now. But it's important to remember it hit a 52-week high of $4.35.
So it's pulled back quite a bit.
A lot. But the momentum is healthy. We're seeing credible support established between about $1.80 and $1.90, meaning the market is defending that level, and the current resistance is sitting right around that $2.10 to $2.20 mark.
And breaking that would be the next signal.
That would signal a fresh move up.
Yeah, is this just retail investors chasing a story, or are we seeing institutional money moving in?
Well, the momentum indicators like RSI and MACD, they suggest the buying is pretty healthy and broad-based, and it's not signaling that the stock is, drastically overbought.
Yeah.
We've actually seen volatility calm down recently.
Which could be a sign of bigger players.
It's a key sign of more stable, managed accumulation. It suggests institutional involvement.
But we keep coming back to this paradox. You laid out a severe solvency risk. So why are analysts still calling this a strong buy with 170% potential upside? Isn't that just pure speculation?
That is the core question every investor has to answer for themselves. The consensus is overwhelmingly bullish, strong buy, or moderate buy, with an average price target of $5.50.
$5.50, that represents what, over 170% upside from here?
It does. And that massive target is based on a future state where the technology is won, where it has captured significant market share, and profitability has stabilized. They're basically applying a venture capital valuation model to a public stock.
So what has to happen for them to justify that huge jump from $2 to $5.50?
They're pricing in two big things. First, hitting a critical scale where the unit economics finally turn positive. That means they need to guide to profitability in the next 12 to 18 months.
Okay, that's one.
And second, a major strategic validation event. The analysts are betting heavily that the company secures one of those rumored partnerships, maybe with a huge infrastructure firm or a top cloud provider. That would de-risk the financing challenges overnight. Without that, that $5.50 target is pretty much a fantasy.
Okay, let's talk about those inflection points. What are the immediate catalysts, say, over the next 3 months that could make or break this whole story?
Well, the most immediate one is the Q3 2025 earnings report. It's slated for November 20th. The market is absolutely positioned for more of that triple-digit revenue growth.
So a disappointment there would be brutal.
It would punish the stock, yeah, especially if guidance shows costs are still accelerating faster than revenue.
What about structural things outside of management's control?
You'll want to watch the ETF rebalancing event in early December, specifically December 2nd. If NXXT gets big enough to qualify for key small-cap index trackers, that creates structural passive demand. Funds have to buy it.
Right.
And then 2 weeks later, January 8th, is the institutional ownership filing deadline. That will show us which big funds, if any, started new positions in Q4.
Beyond the calendar, what about operational news? Or even rumors?
Operationally, they are executing. They're expanding into new U.S. markets. There's that new mobile fueling hub in Fort Myers, Florida, and they're deploying, I think, 144 vehicles for that business. So there's real stuff happening on the ground.
But the big stock moves come from the speculation.
Exactly. And the explosive potential is in those speculative drivers. There's constant market buzz about a major strategic partnership or a pilot project in early 2026, maybe with a top cloud or AI provider.
So that would be the validation you mentioned?
It would fundamentally re-rate the stock and ease that capital burden. And then you have the unconfirmed rumors about, faster international expansion or big government contract wins.
But that all comes back full circle to the central risk, doesn't it? It all depends on them having the money to do it.
Absolutely. The number one risk here is execution, and specifically funding it. Can management integrate these expensive acquisitions, hit their expansion goals, and get the capital they need without causing massive shareholder dilution?
It's a tightrope walk.
It's a complete tightrope walk. If that cash flow stays negative, dilution is the most likely path, and it will just chip away at any returns, even if revenue keeps soaring.
So wrapping this all up, what does this mean for someone listening and considering this stock?
Look, this is textbook high risk, high reward. For a swing trader, the setup is really attractive. You're focused purely on momentum heading into the November 20th earnings and all the partnership rumors.
And for a long-term investor?
For a long-term growth investor, this is only suitable for portfolios that are specifically looking for very early stage, very high risk innovation exposure and energy. You have to be prepared for extreme volatility and, frankly, the potential for a complete loss of capital if they can't secure that financing before the cash runs out.
That's a very clear line in the sand. So here's a final thought. Given that 196% revenue surge versus the negative $50 million in cumulative losses, what level of growth execution would you need to see in the next quarter's guidance to fully dismiss the profitability risk?